Hello, everyone, and Happy New Year. Thanks for joining me today for Elliott Wealth Management's 2025 January Economic Update. To let you know, today's presentation will be with me, your host, Christopher Calandra. There is going to be a paired broadcast with my teammate, Brett DiPasquale. That'll be issued or published very soon. We'll get his thoughts on my comments today, as well as some information that he wants to share with all of you. So please check out the follow-on version of the 2025 January Economic Update. Again, that one will have Brett DiPasquale joining me. So let's jump right in. I wanted to start with a revisit of our 2024 analysis. So we had expressed all year in 2024 cautious optimism. That was sort of the phrase of the year, if you will. And our base case was for a soft landing. We talked a lot about it on previous economic updates and with clients and during our communication with clients and others during the 2024 year, a case for a soft landing. A soft landing is where we avoid a recession, the Federal Reserve being able to bring down inflation without doing undue harm to the economy. And I think the data is very overwhelming that the Federal Reserve was able to pull off a soft landing. We had inflation peak in 2022 at around 9%. It's now in the 3+% range now, not where the Fed wants it to be, but we did engineer a soft landing because we avoided a recession and we've had good economic growth while getting inflation under better control. So in the last economic update we did, the formal one, which was in July, we expressed some causes for optimism. These were very similar to the ones we did in January of 2024. We pointed out that the stock market usually goes up when an incumbent president is on the ballot. That held true last year, even though we had the strange circumstance of the incumbent, President Joe Biden, stepping down at a late point in the election cycle. But nonetheless, this trend of the market doing well when you have an incumbent president on the ballot held, and that helped us out. And we're happy that we were able to lean into this trend to help us figure out our forecast for 2024. We thought there would be manageable inflation. We thought we'd have a passive Federal Reserve that might cut interest rates. That is exactly what happened, manageable inflation. And the Federal Reserve, the second half of the year, began their latest rate cut cycle. We had low employment. It's not as low as it was in 2023, but still hanging around that 4% level is historically on the lower side of the unemployment numbers. And the consumer was still hanging in there. That was cause for optimism through 2024, again, including our most recent formal economic update, which was in July of 2024. So we got a lot right. I'm very proud of that. We also pointed out some reasons to worry. We talked about political uncertainty and upheaval with the presidential election being as divisive as it was. We were worried that maybe we would have a contested election, perhaps violence or just bad behavior by some people in the country. Fortunately, that did not come to pass. I think it was a benefit that we had a presidential election that had a decisive win. It didn't stretch out for days, no court cases, no recounting. It was pretty clean, and I think that was to our benefit. We talked about stagnant household wealth, that the wealth of American households had not done well under the Biden administration. That's not a political statement, just a look at the actual data and facts, and that it was worrisome. Could the market, could the economy continue to forge ahead even though we had stagnant household wealth? Well, we did in 2024. I'll talk about this in the next slide or two or three about how well we did last year. We were worried about geopolitical tumult, and even though there is still a lot of geopolitical disturbances, we still have the war in Russia and Ukraine. We have Israel and Gaza and Hezbollah going at it. We have the Houthis in the Red Sea firing off missiles, upsetting shipping lanes. There's still a lot going on, but none of that really bled into, and I did use that word specifically, bled into the economic forecast of the United States. It really didn't affect the economy or the markets, even though it's upsetting to see what's happening around the world. We're going to talk about this in a few slides. Federal debt and finances. The federal debt, both the deficit each year in the budget, as well as the overall federal debt, is a looming problem that is something to worry about, and I think is something that's getting in greater and greater focus, not just of the federal government, but I also think the American population starting to pay closer attention to that. And then we talked about the long-term status of the dollar, the idea that we're worried about the dollar not being the currency of the world. I'm not going to spend much time today talking about that. I think that is an issue for much later down the line. So that's a quick review. Again, I said this before, I'm very proud. A lot of our forecast and our thinking going into this year was either spot on or very close to accurate, and that helped us. We had a wonderful year last year as a business serving our clients, and the markets cooperated. More on that in a bit. But let's talk now about 2025. I mentioned before that sort of our phrase of the year was cautious optimism. I want to coin for us this year, the trend is your friend. And the trend is your friend because we have had a bull market in the stock market, generally speaking, since October 2022. And my thinking is that the bull market can continue, although modestly, in 2025, and that the trend is our friend. We'll talk a little bit about the reasons for optimism on why the trend is our friend. To begin with, there's a lot of optimism about Trump's second term. Now, talking politics in business circles can be tricky, and I always attempt to be fair and careful. I don't want to throw bombs, but I think, at least to me, it's clear that there's a lot of optimism about the Trump second term. The business community seems to rally around it. Some of the animosity that we saw the first time he was elected seemed to be not as hot as it was before. There is thinking that he will be able to maintain and grow the economy and have some good policies to help us along. We'll have to see how that plays out. But this optimism for the second term of President Trump already played into the markets as we had a pretty good stretch right after he was elected. December was a little tough, but cause for optimism on why the trend is our friend in 2025 is a lot of optimism about what the economy and the markets might look like under Trump's second term. We have a benign Federal Reserve. The phase where the Federal Reserve raised interest rates, the most aggressive rate cutting cycle the Federal Reserve had ever done in history, is in the rearview mirror. We now have a benign Federal Reserve where they're likely not to raise interest rates. They are likely to either stay put or cut interest rates. The consensus is that the Federal Reserve will cut interest rates 2 times this year, following up on the few rate cuts they did in late 2024. Kind of agree with that. I think we here at Elliott Wealth Management agree with that. We think we'll continue to have manageable inflation. We're not going to go back to the very, very low rates that we had before and during COVID, probably. But at that 3+% level, it might not be exactly where the Federal Reserve wants it to be. They want it to be, at least publicly, they've announced they want it to be closer to 2. But this inflation, although a thorn in the side of Americans, is probably not so problematic that it upsets the apple cart. And then the last cause for optimism I wanted to cite was healthy economic fundamentals. I touched on this earlier. discussing 2024, it does not seem that we are at risk for a recession. We have good GDP growth, not great, but good, solid economic growth in the United States. We have a healthy unemployment market. Again, the unemployment rate hovering around 4%, not as low as it used to be, but pretty low by historical standards. And when you add into the economic fundamentals this optimism, I feel that the economy and by extension the markets can have a successful year in 2025. That's why the trend is our friend. What I want to talk about before we get to reasons to worry is I want to talk about U.S. spending. I did this, and Brett and I did this in July, is talk about U.S. spending because I think it is increasingly becoming a problem. And it's something that will need to be addressed, even though it hasn't been addressed probably since President Clinton's administration. But government spending is higher than revenue. So picture this like a business or your household. The government brings in revenue and then it spends money. The government is spending way more than they bring in. Even though the government's revenue is also at all-time highs, it seems as though no matter how much money they bring in, they manage to spend more and more, outpacing any increase in spending, in revenues. So in 2024, and I had a slide on this in July, the projected deficit for 2024 was $1.6 trillion. It actually came in worse than that. The actual deficit for the fiscal year, and the fiscal year for the federal government ends on September 30th. So the year ended on a fiscal basis for the federal government on September 30th, 2024, and the deficit was worse than projected, 1.8 trillion instead of 1.6 trillion. The projected deficit for 2025 continues to see it increase, going up from 1.8 trillion to 1.9 trillion. This, again, as a citizen, as well as a financial planner, I think needs to get addressed because it is unsustainable. Let's pair the spending problem, if you will, with the U.S. debt. So the U.S. national debt is now growing by about $1 trillion every 100 days. That's crazy. That's about 3.6 trillion a year. And what's happening is the debt service, let me say it this way, the amount of debt that the U.S. government has keeps growing. And that means that it has to pay interest on that debt. They're borrowing money and they have to pay interest on those loans. The interest on those loans now cost, as of November 2024, about $169 billion a year just to pay the interest on the debt. The interest cost amounts to about 13% of total federal spending in fiscal year 2025. So I mentioned that the government's spending a lot of money, spending way more than it brings in revenue. A lot of the money that they are spending is not even necessarily on defense, welfare programs, other things the U.S. government spends money on, sometimes wisely, many times not, is 13% is going to just service the interest on its debt. So this needs to be addressed, and hopefully the country, the Trump administration, ideally in conjunction with Democrats, Republicans, can come up with a way to not solve this issue, but at least begin to change the trend and start to see some modest improvements. It's not a problem we got into in a year, and it's not something we're going to get out of in a year, but at least if we could reverse the trend, that would be very positive. Part of the optimism that we see with the Trump administration, I believe, is the thought that the Trump administration can begin, under the mandate that they have post-election, to make some progress on that front. We'll have to see how that turns out. Let's talk about reasons to worry. I have a slide or two on this afterwards, but the S&P 500 is historically expensive. And I will tell you, this weighs on me a bit. I am optimistic, as I outlined for you already, if you ask me for one thing that concerns me, that's separate from, war breaking out or some crazy unexpected event, is that the stock market, given the run up we've had since October 2022, this bull market that's been very strong, is that now the S&P 500 is historically expensive. I'll provide some color on that in the next slide. I'm also worried because the market indexes, when you look at the S&P 500, the Dow Jones Industrial Average, the NASDAQ, these indexes have posted very good returns in 2024, following up very good years in 2023. The thing is that it is very much a case of winners and losers. There's a relative few amount of companies that are really carrying the day. And there are lots and lots of other companies that have not had much in the way of investment returns. So the indexes are doing well, but it's not like there is a lot of widespread success amongst the indexes. Using the S&P 500 as an example, there's 500 companies. Most of the returns are probably concentrated within 20, 25 companies, maybe even less, depending on how you want to slice and dice the data. Another reason to worry is the opposite of this optimism about the Trump second administration, or second term, I should say, is that will his administration, in combination with the Congress, be able to function and do some good things for the American people? There's optimism there, but that could be dangerous. They are going to have to deliver on one or more items in order for this optimism and these good feelings that are present in large portions of America, including the business community. It's got to work out. So that's something we're going to watch. Related to that is this excessive optimism. When you look at various surveys, and I have a slide, I think it's 2 slides from here, we'll talk about this excessive optimism. And I wonder if it is a contrarian indicator. We'll talk about that more in a moment. And then always a reason to worry, especially these days, is will the geopolitical tumult, I mentioned to you before that so far it hasn't bled into the US economy and the markets, but it could, if things get completely out of control in one of these theaters where people are dying and they're shooting and there is issues. Could it get out of hand or spread where the risks become so pronounced that it does affect the economy, affect consumers, and drag the market down? So far, we've dodged that worry, but it is still a worry that we want to watch. Let's focus on the expensive market. I talked about that. So the S&P 500 on a forward price to earnings ratio, or forward PE ratio, is at 22.3. I don't want to go too far into the weeds, but price to earnings is basically the price of a stock or the price of an index versus the earnings that that stock or index is expected to deliver. So it's a ratio between how much you're paying for an investment versus how much that investment is supposed to earn or is expected to earn in profits. In a forward PE, it's what's expected for earnings. So it's 22.3. Now, for most of you listening, that probably doesn't mean anything. But here's what I want to share with you, is that in the last 5 years, the average has been 19.7. So we've gone up quite a bit over the 5 years. And that makes sense because we've had a very good run over the last couple of years, this bull market I keep referring to. It's driven up the price to earnings ratio because the market price for stocks and indexes have outpaced the earnings growth of many US companies. Now, I'm using the S&P 500 as a proxy. I think that's a good one to use as a benchmark. It represents the 500 largest US companies that are publicly traded. So it's at 22.3 now. The 5-year average is 19.7. The 10-year average is 18.1. So it keeps creeping up. The market is getting more expensive. And I can make a very good case that something will have to give. Either earnings of S&P 500 companies in the aggregate have to come in higher than expected, which certainly could happen, especially if the optimism of the Trump administration comes true and we have a good period moving forward into 25 and beyond. We could grow into that price to earnings ratio. Or maybe prices have to come down, which means, or it could just have slower growth, allowing the earnings to kind of catch up. If you go back even farther, the price to earnings ratio sometimes is lower, but I wanted to point that out to you. 10-year average is 18, 5-year average is 19.7, and we're currently at 22.3. The market is expensive. Now, since 1985, did some research on this. Since 1985, there's only been 2 times where we had a price to earnings ratio above 22. That was in the years 1998 to 2000, often termed the tech bubble. You know, that's where you had internet companies really take the markets by storm. Those were unbelievably great years for the market and for investors. On a worrisome note, though, that was followed by 3 really bad years. 9/11 attacks had something to do with that. But after 98, 99, and 2000, where the market was very expensive and returns were outsized, we went into 3 years where the market did very badly. Now, some of that, again, was not just economic, but driven by the damage done economically as well as psychologically after the 9/11 attacks. The other period I mentioned twice since 1985 was recently in COVID, when you had big sell-off when COVID first hit us hard and we had economic shutdowns and a tremendous health scare. Well, when the market recovered, and it recovered rapidly, we got an expensive market, and PE ratios, price to earnings ratios, got over 22%. Sort of makes sense to me. There was optimism that U.S. economy would really bounce back strongly. So prices, stock prices, were bid up strongly in anticipation that the earnings would follow. So we did have a period when the price to earnings ratio during COVID and coming out of COVID, the market was as expensive roughly as it is now. But then 2022 was a reset year. We had a really bad bear market, down year in 2022. Now, some of that was based on price to earnings, maybe. The big driver really was inflation, but things sort of got right-sized then. So I'm not suggesting that the market is doomed this year, but it is something to worry about, this expensive market. If we could get good corporate earnings, if we could get good economic growth, part of that will be, you know, businesses making good decisions, consumers staying healthy, maybe helped along by our politicians, fingers crossed. If we could get good corporate earnings, this could work itself out. But it is definitely something that we want to watch, something I wanted to share with you because I think it's key. The other item I wanted to delve into a bit is this contrarian thought. There's a lot of optimism. I've said that several times already. As an example, there's a November 2024 survey that indicates 56.4% of U.S. consumers expect the stock market to rise in 2025. Now, the thing about that is that's the highest reading on record. So on one hand, that's good news. That's good news. A lot of optimism. But this overconfidence, or perhaps this is overconfidence, that might signal irrational optimism. Maybe this is a contrarian indicator. Maybe the idea that so many people are expecting so many good things, maybe they'll end up being disappointed and there might be problems on the horizon. So that's a contrarian thought. I've been in the business for well over 30 years now. My team is very experienced. Marshall Rosen has been in the business longer than I have. Brett's been in the business 17, 18 years. Lindy Brock has been in the business, I don't know, 12 to 15 years, something like that. You know, I've gotten a little paranoid. We get a little concerned. We've seen lots of things. And this confidence level, for some reason, weighs on me a bit, so much so that I included it in this presentation. If you think about it, we have a lot of research at our disposal. I and the rest of the team do a lot of reading, a lot of talking, a lot of thinking about these things, and only so much could come into a concise economic update such that I'm delivering to you today. But this was so important that I wanted to share with you this idea that it's great that there's so much confidence about the markets, but there might be an underbelly to that. Maybe it is a contrarian indicator. So the two things I wanted to drill deeper into is the market's expensive. People are very confident about the market being able to perform well this year. These are things we want to watch. So as we wrap up, this is something that I always say in economic updates, is I want to share with you, if you're a client of ours, what you could expect for us, what you can expect from us. That is regular review of changes that may affect you. We want to communicate regularly. Economic updates like this is a good example. We typically do 2 in January, 2 in July, and in some years we'll do others depending on circumstances. We do the Simply Financial podcast, which is published weekly, and we've been doing that since I think 2017. We'll do monthly mailings, we'll do email alerts, we'll do regular meetings. If you contact us, if you send us an email, you call us, we will be super responsive. We want to serve you well. We are going to continually review economic, tax, estate, and investment issues for our clients. Your health and well-being is our highest priority. The team and I, we really appreciate the opportunity to assist you with your financial needs. We are always, always planning for your success together. So thank you for listening and joining me on today's economic update. Again, please remember there's going to be a second version of this where Brett DePasquale joins me. He will share his thoughts on what I discussed with you today, as well as share some new information with us, sharing with us some of his thoughts and views on these key economic and market issues. So you get an idea of what we are thinking, the team and I are thinking here at Elliott Wealth Management in 2025. Thanks again. Happy New Year.
The views expressed are not necessarily the opinion of Osaic Wealth, Inc., and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. Please note, the information being provided is strictly as a courtesy. When you link to any of the websites provided here, you are leaving this website. We make no representation as to the completeness or accuracy of information provided at these websites. Nor is the company liable for any direct or indirect technical or system issues or any consequences arising out of your access to or your use of third-party technologies, websites, information, and programs made available through this website. When you access one of these websites, you are leaving our website and assume total responsibility and risk for your use of the websites you are linking to. Securities and advisory services are offered through Osaic Wealth, Inc., member FINRA, SIPC. Insurance services offered through Elliott Wealth Management Services, LLC, not affiliated with Osaic Wealth, Inc.